So for this session, it is just me, I'm afraid, talking again. But this session is talking about permanent establishments, or PEs. So if I'm using the abbreviation PEs, I mean a permanent establishment. And all I want to do in this session is talk about some of the key concepts and some of the things that have changed and that are changing in international law, and look at a few things on this because the concept is quite relevant. But it is only one tool in any tax authority's armoury in terms of taxing the profits of an entity or a business or an enterprise carried on in a particular jurisdiction. It's only one part of the jigsaw. So I'm being a little unfair in this because I'm talking about PEs, then I'm asking you to do the first part of the case study, and no doubt your focus will be on PEs. There are other elements that will be relevant to that, but we'll be covering a lot of those tomorrow. So tomorrow we'll be talking about double tax treaties, we'll be talking about the concept of substance and other things that are relevant to all the planning in this area. But just for the moment, we're just going to focus on this particular aspect. And what I want to do as part of that is just talk about the key considerations with PEs when we're looking at any kind of international tax structure or international tax planning. There have been some changes in how double tax treaties work in this respect, and some of the definitions in double tax treaties have changed, and changed quite subtly. There have been for a long time points to do with PEs where is something a PE or is it a commissionaire arrangement? Do you have something that's what's called a dependent agent? All these terms are quite important in determining whether or not you've got a PE. And there have been some cases that have gone through the courts in different jurisdictions that have been quite helpful in setting some of the parameters for where those definitions lie. So I will look at some of those cases and we'll try to agree what the logical inference is from the conclusions of the courts, and we'll apply that to the definitions of PEs as they are, as the revised definitions of PEs, as they are now in the model tax treaties. Where you have a PE, then what that does is that gives the right of the country where the PE exists to tax the profits of that PE. Well, what are the profits of that PE? Well, they're the profits attributable to that PE. Well, how do we determine that? Does it have any profits? I've got one case on my desk at the moment where having a long debate with the inspector in the UK about whether or not we have a PE when you look at the provisions of the Jersey-UK double tax treaty. And actually, I happen to know the inspector's probably right that we do have a PE, but I also happen to know that it don't matter one jot because there ain't in no way there's going to be any profit attributable to that PE, and we're playing a little bit of a game arguing about the definition of PE, knowing that actually there won't be any tax that's attributable there anyway. It's because we're into a transfer pricing analysis, which I'll touch on as I go through this. So what profits apply to the PE and how you work out what those profits are is key to that, and we will look at what the risks and opportunities are. And just for, I completely appreciate there are very different levels of experience in the room and there are different levels of knowledge. So just, just as a kind of reminder for anybody who's just not familiar with this really, if all we're talking about when we're on about a PE is one about, and we'll just use the UK as an example, one about a company in the UK, so a UK company, and this UK company decides to sell its goods and services in another jurisdiction. Somebody give me another jurisdiction, please. Australia. I'm afraid Australia wins because that was said a little louder than, was it Germany, the other one? So we'll say Australia, okay. So we have Australia, that's a little long to write out actually. Chad would have been better. So we've got Australia over there. So this is the UK. That's obviously the UK border. This is Australia. This is not to scale, ladies and gentlemen. This is Australia over here. So we're carrying on business in Australia. We're selling products in Australia. We might be doing anything in Australia. Okay. But we don't set up a company there. So we don't create a company there. We don't create a partnership there. We don't register anything on Australia. So to the untutored eye, that's the taxable entity. It's making some profit over here, but it's all taxable there. Well, is it? Because have we created a taxable presence here? And that's what PE is about. It's do you create a taxable presence? And most countries have rules about what creates a taxable presence, even though you technically haven't created something that is a taxable person. Everyone familiar with that, yeah? I just wanted to put that down just so that everyone we don't lose what sight of the big picture and what it is we're actually talking about as we go through this. So that's what we're going to cover in this session, and then you all get to go off and have lunch and chat in your groups of equally intelligent and useful people. So what is all this about? The point I really want to make on this is that often things that land on my desk start from a premise. They start from, oh, we don't want to have a PE in that country. How do we avoid there being a PE in that country? That's the wrong way to think about it, because permanent establishment, whether you've not got a PE and whether you have a taxable presence in Australia, well, is that good or is it bad? And actually, it's a bit like when people talk about treaty shopping and they say, oh, look at the different double tax treaties. That's not really what you're on about. Treaties don't tax you. And permanent establishment rules don't tax you. It's the local jurisdiction that taxes you. And the question of whether or not you want a PE is actually an open question. You might be quite happy with having a taxable presence in the other country if actually it works in your favour, and in some circumstances it might. In other circumstances, you might not want there to be a taxable presence in that country. And if you actually want there to be a PE in that company, you might decide that setting up an Australian company is actually a better idea anyway, or setting up an Australian limited liability partnership might be a better idea anyway. Who knows? The point is that understanding the impact of the PE rules is the key thing. It's where do they fit into the picture, because they might completely undo something else that you're trying to achieve. Does that make sense? So it's not necessarily a bad thing. It's not necessarily a good thing. You might want it. You might not. It's part of the picture. You need to plan for that, and you need to understand where that fits in. This is just going back a step, really. It's almost forget any special rules, forget rules about PEs. Why are we trying to put things into different jurisdictions? Why are we interested in this? What can be achieved by this? And this is the example I love to give, which is a Saudi company. And so we're using Saudi here because Saudi is the biggest exporter of oil in the world. And some of you may be familiar with Saudi Aramco, who are a client of Baker Tilly International. Saudi Aramco is now actually the world's largest company now that's floated. It's basically taken over the Saudi national oil industry. But you don't have an effective double tax treaty between Saudi and the US, even though it's the largest exporter of oil to the US. So a Saudi company may be tempted to, maybe slightly concerned about this. If a Saudi company is operating through a US subsidiary, then what you'd have is this. You would have corporate tax, where's it gone? You'd have corporate tax in the US where it's actually 35%. And you would have a dividend that's being paid back. So the net dividend that's being paid back after withholding tax going back into Saudi. Still a corporate rate in Saudi, and no relief for the withholding tax that's charged on the dividend, and no relief for the corporation tax. Why don't you get double tax relief there, by the way? You've been taxed in the US on your profits, then you're taxed again on withholding tax on your dividend. Why is there no double tax relief there? Come on, you all know this. What do you get double tax relief for? Basically. Thank you very much indeed. Precisely. Did everyone hear that? The answer from Romania, we have it's going to be like Eurovision Song Contest here. Romania right at the top of the board at the moment. Croatia bottom. Sorry? So the point was there that you only get double tax relief for the same types of income. Now, of course, to the uninitiated, they'd say, whoa, 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 it is the same type of income. That's almost selling oil, ain't it? And you'd have a point, except that isn't how tax law works. Tax law recognises different types of income. The receipt in Saudi is, in this example, is dividend income. What's been taxed in the US is tax on profits, corporate tax on profits. You've had corporation tax, you've then got withholding tax on dividends. They are not the same thing. You may get some relief, except you don't have a double tax rate. You may get some unilateral relief on that. But that's as much as it gets. So the point is, without any other thinking about it, a basic structure through which Saudi Aramco, for example, might operate to sell oil in the US might look something like that. Well, that's not brilliant, is it? So it might be tempted instead to set up a structure that would look something like this. And This is pretty basic stuff, isn't it? You've got Saudi Aramco there at the top. You've then got a US company that's a 100% subsidiary. Except what it now does is the US company, the Saudi company charges for, let's say, management services that are provided by it. This US subsidiary doesn't know anything. It can't do anything. It needs all of the expertise of Saudi Aramco to be able to sell one drop of oil. So Saudi Aramco sends it a whopping great fat bill for all of the expertise and the services that it provides in helping the subsidiary to sell in the US. Does that make sense? What's that done? It takes away the US tax charge. And instead, what we have is we have fees for services that are paid back, and there's no withholding tax on those because there isn't, because the US won't withhold tax on that. It doesn't need any restriction under a double tax treaty. There isn't a withholding on it at all. Can we spot the difference? Okay, so you've gone from 66 to 20. And in the simplest analysis, without any special kind of regimes, without any special anti-avoidance rules, something like that might work absolutely fine. It still might work fine, actually. You might be able to set up an arrangement like that where that has plenty of substance, where that really is carrying on a job, where it really has to pay for the expertise that Saudi Aramco can provide. You probably wouldn't get it down to zero, but you probably wouldn't get the corporate tax in the US down to zero, but you might get it pretty low. And isn't actually creating a taxable profit in the US, because if you set up a company in the US, then that is going to be taxable in the US. But if you decide you're not going to do it through a company because you don't want to be taxed in the US at all, you might try to operate through another arrangement, and then the question would be, does that other arrangement amount to a taxable presence in the US? But you can see in a situation like this, you might be perfectly happy to have a taxable entity in the US. You might actually start from the premise that you're not bothered about trying to avoid the PE rules. You might be perfectly happy to suffer corporate tax there because you can manage it. In other circumstances where you aren't able to charge those amounts and you do have some kind of business being carried on in the US, let's say you've just got agents running around going to petroleum companies trying to market your oil, in that situation and where you can't put in the same charging arrangements to reduce the taxable presence here, there you might be worried about whether or not you've created a permanent establishment. Okay. The BEPS actions did look at permanent establishments, and they identified PEs and the definition of PEs as being a problem area. And they identified that people were deliberately trying to avoid there being PEs. Of course, the point I made at the start is don't assume that's what is good. But in lots of cases, it will be good. In lots of cases, you will want to avoid a taxable presence in another jurisdiction. It might not even occur to some people that they have got a taxable presence in another jurisdiction. They're just a French company. They just happen to have people on the ground in the UK running around trying to sell something. It might not even occur to them that they've got a taxable presence there. And in lots of situations, it was noted that there were attempts by enterprises to avoid being a permanent establishment, avoid having that status. And that was largely through the use of what are known as commissionaire arrangements. Can you raise your hand if you know what I'm talking about when I say commissionaire arrangement, please? Somebody, that was a finger. I'll count that as a hand, madam. Thank you very much. Yeah? Any other hands? Okay. Well, I will run through this in a bit. The commissionaire arrangement is the classic arrangement to avoid getting within PE status, where you can carry on business in a country, where you can, it's largely getting your sales function into another country. So having that as a market, rather than you just operating remotely and through a website in the UK or a website in Australia or wherever, actually getting something there on the ground, feet on the ground, doing your job for you without creating a PE. That's probably the main thing that some of these changes were intended to block. Under the BEPS action plan, that wasn't compulsory, actually. It's not saying that countries have to introduce a rule, and there's nothing in the EU directive telling countries that they have to introduce a rule about the definition of PE. They can do if they think that's a sensible thing, but there has been a change to the OECD Model Tax Treaty, Model Tax Convention, which does, as a default, give you a slightly revised definition of what a PE is, and that's intended really to tackle commissionaire arrangements. I'll explain that in a few minutes, yeah? Okay. Yeah. Just a little bit of background to how this came about. It goes back to October 2015. And remember, the G20 were the ones pushing forward with the BEPS kind of initiative to start off with. The OECD had kind of stuck their nose in by this point. And it was identified that it was a good idea to have something that dealt with preventing businesses, stopping businesses, sidestepping the effect of permanent establishment status. And it looked at the double tax treaty, the model double tax treaty, and it recommended some changes that were really used at preventing certain, what I'm called here, common tax avoidance strategies that have been used to circumvent that, and that really is the commissionaire arrangements. And this resulted in a change to Article 5 of the double tax treaty. This is the basic point. What Article 5 of the Model Treaty does is it defines when you have an entity with a sufficient level of presence to mean that you have created a taxable presence in that particular jurisdiction. That's what Article 5 is intended to do. And it gives various definition terms, which we'll talk about in a bit, if I will talk about them now. Because what Article 5 talks about, this before I get on to what changes have been introduced in Article 5, what Article 5 talks about is a fixed place of business. So I pull out all these elements deliberately. Because in order to fall within the definition of being a PE, you have to have something that is fixed. That doesn't mean that you own it. It just means that it's something where you can identify its location. So it's not something that can be moved about. So in other words, driving your car over to that jurisdiction does not create a fixed place, does it? But it's got to be something with a degree of permanence, but not necessarily a particular legal standing. So you don't have to have a legal entity like a company. But if you've got access to some premises or access to something like a warehouse, then that's likely to produce a fixed place for this purpose. And different model tax treaties have different definitions that apply to building sites. So, for example, in the OECD model treaty, you've got a certain length of period that a building site has got to be in existence for that to be a fixed place. And in the UN double tax treaty, in the US, well, the UN double tax treaty, it's slightly longer period that it's got to be fixed. So things like building sites, things like any buildings that you've got access to will be fixed. And as I say, it's got to be a place. That can mean it's not just buildings, it can be other things. It can be like, some kind of manufacturing facility. I've never seen a manufacturing facility or plant of machinery that isn't in a building, actually, but I'm sure somebody can come up with some circumstance. Oh, actually, so no, I can come up with one. In fact, I'll give an example of a case a bit later that actually turned on that very point. But the actual thing, the plant or the thing, doesn't need to even be in a building. It can be something that you're using. And it's of business, where the business of the enterprise is wholly or mainly carried on. What does that mean? Well, again, there's a case I'll mention a bit later on that draws a distinction between what is the business and what is a function that you've just subcontracted to somebody else. So all those things need to be present. Everyone happy with that? Okay. I just want to tell you how the Article 5 has actually been amended, and I'm afraid I can't do this from memory, so I have to refer to my notes, and I need to put my specs on. So what the Article 5 used to say was, subject to the provisions of paragraph 3, where an enterprise of a contracting state carries on business in the other contracting state through a permanent establishment, so where a member of a contracting state, there you go, carries on business in the other contracting state, that's the other party to the double tax treaty. Where did I get to? Oops, I lost my point. Carries on business in the other contracting state through a permanent establishment situated therein. There shall, in each contracting state, be attributed to that permanent establishment the profits which it might be expected to make if it were a distinct and separate enterprise engaged in the same or similar activities under the same or similar conditions and dealing wholly independently with the enterprise of which it is a permanent establishment. In other words, we imagine that whatever this is in Australia is its own person. It's its own business. And yeah, it may have dealings with this entity in the UK, but it does it on an arm's length basis. That's what we've got to imagine. Imagine all that. Think about all that. Think about the terms on which this would lend. Think about the terms on which this would transact stock. Think about the terms on which this would provide services. Think about the terms on which this would be able to use that company's IP. Imagine all those. Sounds a bit like transfer pricing, doesn't it? And of course it is. And it's tied into Article 9 of the Double Tax Treaty, which ties it into transfer pricing. We'll come on to that in a bit. Imagine all that. That's how you work out the profit. But they changed the Double Tax Treaty to include the Standard Double Tax Treaty, to include the following words. It's, again, it still says the same thing. It's for the purpose of this article, the profits that are attributed in each contracting state to the permanent establishment referred to in paragraph 1 are the profits it might be expected to make, in particular in its dealings with other parts of the enterprise, if it were a separate and independent enterprise engaged in the same or similar activities under the same or similar conditions. Here we go. Taking into account the functions performed, assets used, and risks assumed by the enterprise. That's the only real material change that there's been to the OECD model treaty, taking into account the functions performed, the assets used, and the risks taken on by that enterprise. And again, for anyone who's familiar with, who's a transfer pricing specialist here, or has got one? Sounding familiar? Yeah, I thought it would. By the way, if we get on to transfer pricing, this is yours, as is the flip chart, okay? Because this is something that I don't do day to day. And I get bamboozled by the different methodologies that are available under transfer pricing. But the point is, what you have to do is you have to go through what a TP specialist would talk about as being a functional analysis. You actually have a look at it. You work out what it's doing. And you look at it in terms of what it's doing by looking at the individual nuts and bolts of that, working out what this really is as a business, and then attributing a profit to it. That's what you intended to do. So really, the only real change that came about to the model tax treaty because of this particular BEPS action is a technical change to push this more into the realms of transfer pricing methodology rather than into if you like, a normal common sense methodology about what the business would produce. How big a difference that's made, I'm not sure. In fact, nobody's sure. There's a lot of debate about it. So that's the big change that was introduced. And was it a big change? Don't know, but that is a change that was introduced. Everyone with me on that, yeah? So it's just a technical change, really, to the Article 5 definition of the standard OECD, of the OECD model tax treaty. But is likely to have a knock-on effect into how you actually calculate the profit attributable. Okay, I mentioned, and this brings me on to another change that was introduced in the definitions, which is important. I mentioned that lots of people have tried to avoid the impact of permanent establishment rules, PE rules, by using what are known as commissionaire arrangements. And I only got one finger in the air when asked if anybody knew about commissionaire arrangements. So what I will do is I will do my best to describe them. There is law on commissionaire arrangements. There isn't in the UK, but there is in some jurisdictions. I think Holland's got some commissionaire law, I believe. And anyone can name another jurisdiction that has laws on commissionaire? Germany, thank you very much, sir. So we do have countries where this is recognised. When you place a UK analysis on this, it all looks a bit odd. We worry about it. It basically comes down to this. We have company here, and it's a manufacturing company, so there you go. I'll do a factory. That's my best drawing of a factory, so that's as good as it gets. So you have a manufacturing company here in the UK, and it's trading with this other country over here. And it doesn't want a permanent establishment, but it wants to sell. It sees that as being the main market. So what it does is this. It has guys. There you go, that one's a lady. It has guys over here who run around selling the products of that particular company. No problem there, is there? And except they do a little bit more than just sell. What they do is they go along to the customers and they enter into the customers over here. So there's customer. What they do is they go to the customer and they enter into contracts where the customer agrees to buy the product. But the contract is not with the manufacturer. Instead, the commissionaire has an agreement with the manufacturer that when it concludes a contract with this customer, that this manufacturer will supply the goods to the customer. So there is a kind of tripartite legal obligation. Can you all see that? Yeah? So it's a kind of tripartite legal obligation where this company, under the agreement it has with these people, is bound to supply the goods. Now, technically, it's not, because technically, it could get somebody else to supply those goods. It's just got an agreement with these guys that goods of a certain type and description have got to turn up on a certain date at this guy's doorstep. So in theory, there's no contractual agreement between the customer and the manufacturer in the UK. That's what you're avoiding creating. And that's called the Commissionaire agreement. Does that make sense? Have I done that justice? Probably not. Do you want to add to that at all? Do you want to add to that? Do you want to elaborate on it? Is that okay? Forgive me, I'm sorry. Ich kann nur ein bisschen Deutsch sprechen, also ich verstehe. Okay, so the point about this is that this entity, so these people have not created a contract between this customer and that entity. They can't. They can only create a contract between themselves and the customer. It just so happens that in real life, the effect of that contract, because of this contract, is that the customer gets the same goods. Now, why do you do that? Why on earth do you do that? Because a dependent agent is a permanent establishment, and always has been. Well, always has been as far as I can remember. And a dependent agent, so the question we'd ask is, are these guys here dependent agents? Or are they commissionaires? So are they people who are dependent agents of our company in the UK or wherever it is? And the test of that is that that agent habitually exercises authority to conclude contracts in the name of the enterprise of that other territory. Now, question for you, did they conclude a contract in the name of that enterprise? Well, no. They just concluded the contract in the name of, Tom and Wendy suppliers. And don't worry, guys, we will find you exactly the right, we'll source the goods that you need, we'll source the widgets, the raw materials that you need to do what you've got to do. That is not being a dependent agent. Does that make sense? Okay, great. The change to the double tax treaty, which has sort of put that under question, is this. That's why I wish I'd not put my glasses down. Oh, they're there. There's been a slight change in the standard model double tax treaty to the definition of dependent agent. What it now says is that you've got a PE where a person acts in that state on behalf of the enterprise, and in doing so habitually concludes contracts or habitually plays the principal role to the conclusion of contracts that are routinely concluded without material modification by the enterprise, and the contracts are either in the name of the enterprise or for the transfer of goods by the enterprise. So can you see, they've concluded a contract which is for the transfer of goods by this enterprise. It's not in the name of that enterprise, but it is for the transfer of goods by that enterprise. So now, when you look at that arrangement and you look at the standard wording under Article 5 of the double tax treaty, of the model double tax treaty, you've got to ask yourself, is that a permanent establishment? And it might be. I'll tell you something, I'll mention something that could let you off the hook in a second. And really, this is intended to attack the actions of sales forces that are in different jurisdictions. And the example that I'm giving you, which is the company of which I'm a non-exec director, for the case study later on, that's quite important, because this is a company that will want to sell product once it starts manufacturing product. It will want to sell product in lots of jurisdictions, because the particular product, which I'll tell you about if you're interested, has global appeal and is likely to be of interest around the world. And so it is that commissionaire arrangement that's aimed at. Yeah? Everyone happy with that? Okay. There's a bit of a let out because it goes on, the definition goes on. It says, a PE will not be deemed to exist if the person acting in a contracting state for the enterprise is doing so in the ordinary course of the business of an independent agent. A person will not be considered to be an independent agent if he acts exclusively or almost exclusively on behalf of one or more enterprises to which it is closely related. Okay. So what it's saying is these commissionaires will be dependent agents if they work exclusively or almost exclusively for this company and they are closely related to that company. Now, I think just the fact of working exclusively for that company would make them closely related. But the point is there's nothing wrong with hiring in external people who actually have a job working for some other people as well. Does that make sense? So the exclusivity would be the point that would stop you avoiding PE status. And that's the commissionaire arrangement type thing is quite widely used, and it's quite important to understand that and understand what's being attacked by that change in definition. Does that make sense? A lot of international tax, by the way, turns on these tiny little changes in wording of double tax treaties and the slight nuance of language. And I'm afraid most of the changes and most of the things that we see done aren't really, they're not obvious, because they're quite subtle in the way they're worded, and there's no clarity about how they apply. And I'm afraid that's just the nature of what we're dealing with. Moving on, something slightly different. Not everything that is undertaken by a PE is taxable in the country in which the business is undertaken. So if we take this example again, so we got the business being carried on in Australia. So business being carried on in Australia. We've decided they are a dependent agent, but not everything is taxable. And if you have certain activities, but they're only for these things I'm going to talk about here, or they're of a preparatory nature. So it's either preparatory or auxiliary are the two words that are used. Then if you've got activities which are preparatory or auxiliary, provided they don't normally, in the normal sense, produce a profit, you don't have to worry about there being a PE, and you don't have to worry about going through the transfer pricing methodology of attributing a profit to that PE. Okay, so what are these? Well, here we go. Storage, display, delivery. So if we're trying to sell goods in this country and we just want to set up a shop window for them, or we just want to put them into a warehouse, knowing that at some point customers will want them, and then the customer will just have to come along and pick them up, then that would be fine. If I just said third party, not the thirst party. So if we just have a completely independent third party that is selling our goods onto us, so effectively a retailer of those goods or a wholesaler of those goods, then stock being processed by them won't fall within that. If we're just doing market research in that country, or we're just trying to find out information that might be useful to us in selling the goods, that probably isn't an activity that's caught by these rules. And there are lots of other things that you could possibly find. There's one change that was introduced as part of Article 5 of the, so it's within Article 5 of the Model Tax Convention. And this is really aimed at what's called fragmentation, because it was identified that if you can say, well, certain activities don't actually offend the PE rules, so you can do certain things without having a PE in one of these jurisdictions, well, doesn't that open up the possibility that you kind of break your business into loads of tiny little bits, and you have one bit that is just the storage, one bit that's just the display, one bit that's just concerned with delivery, and you say to the local tax authorities, hey, we haven't got a PE, look, we're just undertaking those activities, look, that's just storage, that's just delivery, that's just getting information. Actually, you add them all together, and you've got a coherent business, haven't you? And there's a rule within the definition to say that if you can actually look at it as a whole and you can identify a coherent business, then you're not out of the woods. You don't escape the effect of those particular rules. Sorry, equipment malfunction, the bane of my life. I think my battery is dead. Wait. Back to the old-fashioned way. Okay, just moving on a little bit, just talk about some practical considerations. If you are, because PE And the definition of PE is one bit of this, isn't it? And it's one thing. This means that you can have an arrangement, I can't point, you can have an arrangement whereby you're carrying on business in a particular jurisdiction, but you might be taxable in that jurisdiction even though you don't think you've got a taxable presence there. The PE rules actually can have that effect. But there are loads of other considerations. And when we're looking at any kind of group structures, it's just worth thinking about these. So if we're looking at an operating company, so actually we decide we can't escape the idea of PE and we just want there to be a taxable presence in this other jurisdiction, we'll hold our hands up and accept that. So we set up a company in Australia. If we're setting up an operating company, there are lots of practical considerations with setting up that company, and they're nothing to do with corporate tax. Because remember, PE is only to do with business tax, isn't it? It's only imposing a local corporate tax rate on the profits attributable to that business. But there's loads of other stuff to think about, and these may be way more significant than any corporate tax rate on the business that you're undertaking there. First of all, if you're sending employees over there, how are they taxed? What about things like VAT or any sales tax or any indirect tax, like an insurance tax? What about those kind of things? Obviously, the headline corporate tax rate is going to be significant, but how's that calculated and what's the tax base for that headline corporate rate? Are there any transfer pricing rules? What does the double tax treaty say about withholding taxes? So can we get profits back from that entity in a tax efficient way? As we saw with my Saudi Aramco, my Saudi company and US company, actually, probably, forget PE, we had a perfectly good working arrangement that actually I think would still now work as long as you do the right things in the US subsidiary and produces a great tax rate without worrying at all about the PE rules. So actually there are lots of considerations that probably in lots of circumstances trump the effect of the PE rules anyway. So, if you're looking at setting up an operating business, if your client's looking at setting an operating business in a particular jurisdiction, these are the kind of things you need to be thinking about, and it might mean that actually operating a company there is absolutely fine. And just doing here you go. These countries may come up when you're looking at doing kind of planning. This is a quick comparison of some of the countries that I commonly come across when I'm dealing with my own clients. And you can see that there are some big variations on this. Employees won't thank you for sending them to Holland or Luxembourg. Forgive me, anyone from Holland or Luxembourg or anybody or Ireland either. You have the UK, in fact, as well. Switzerland fares a lot better than that. Indirect taxes, from 23 down to 8. And it's funny, isn't it? Because all this stuff we're talking about with PE all relates to corporation tax, except the lowest rate on that is 12.5 and the highest is 29.2. So actually, there's probably the least variation on that. There's not that much variation on that compared to other taxes. And all of those jurisdictions actually have quite effective transfer pricing rules. And I mean, what I would say is that, if you setting something up where you are sending a whole load of staff to, let's say, a Luxembourg type structure where you're getting a low rate of corporation tax, not that much lower actually than by the way, that UK rate is now 19, it's going down to 17. So not that much lower than the other rates, but if you send somebody over to Luxembourg, then probably, and unless you have some imaginative way of remunerating them, the employment tax costs are going to trump the corporate tax benefit that you've got anyway. So all these are considerations that you need to take into account when you're looking at setting up anything as an operating entity. And you've got the same thing where you're doing it the other way around. If our client is here and we're looking at setting up a holding company above them, then what we need to do is we need to consider different things. So pretty clearly we need to look at how dividends are going to be taxed, because if we're getting dividends from Australia back to the company in that jurisdiction, are they taxed in that jurisdiction? Is there any exemption from them? There often will be a participation exemption. Lots of countries have a participation exemption where if you hold more than a certain number of shares, then you don't get taxed on dividends or even capital gains on those shares. What withholding taxes would apply on any payment from that? What tax incentives are there? So, for example, when we get into tomorrow, when we're looking at substance, IP, developing intellectual property, undertaking research and development in lots of countries is highly incentivized. In the UK, it is highly incentivized. You can get up to a 230% deduction for undertaking research and development in a UK company. Did you know that? So that's quite a big incentive to encourage people to have an entity in the UK that's undertaking research and development. When you're looking at a holding company, you're considering things like treaty network, because treaties, as we know, do not tax you. Treaties only ever limit the effect of withholding taxes, pretty much. They limit the effect of withholding taxes, so the more treaties you've got, generally, the better. Is there a participation exemption, as I mentioned, for a disposal of the shares in the underlying company? Because that top company might want to sell the shares in that underlying company. Are they taxable? Are the CFC rules in the top company's jurisdiction, and what are the transfer pricing rules there, and how effective are they? They're all the kind of considerations that you want to look at when you're looking at a holding company. And I mention this because it's putting into context the point about a PE. A PE might be a bad thing. You might want to avoid the impact of a PE. Actually, there are lots of other considerations that apply to a cross-border structure that mean, frankly, you might be focusing on the wrong problem. You might not. It might be exactly what you want to avoid, but is it the main thing? Make sense? And just run through a couple of comparisons on this. The only big difference is, you can see, is the withholding taxes and the taxation of dividends in Ireland. So dividends taxable from received from one corporate, received by a corporate from another corporate in Ireland are taxable. They're exempt everywhere else. Gains on shares, there's a participation exemption for disposal of shares in every country. Oddly enough, the UK one's actually quite recent. That was it's not that many years ago that was introduced in the UK, so it didn't exist before. The big one is withholding taxes, and as you can see, you've got a whopping great withholding tax on dividends coming from Switzerland, but of course subject to what might restrict that. Thank you very much indeed. The double tax treaty. That's why we're bothered about double tax treaties. That 35% rate is their domestic law about a withholding tax. This a little glance into tomorrow. What double tax treaties are about is saying, we normally do this, but for you guys, when we're agreeing a double tax treaty, we're going to put you in a favoured status. We won't. We'll limit it to 5%. And that's what the double tax treaty does. And all the stuff about, do you qualify for that? Does the general anti-abuse rule stop you getting the benefit of that restriction? This is one case in where the word restriction is used in a very positive sense. The double tax treaty places a restriction on the country charging the withholding tax, and you'll find that actually most double tax treaties with Switzerland limit that. But if you're dealing with a country where you don't have a double tax treaty with Switzerland, that would be a massive consideration. So yeah, this is what I've just said. On all of those, you've got to look at several things. You've got to look at the domestic rules. You've got to look at the anti-avoidance rules. You've got to look at the double tax agreement. After you've looked at the double tax agreement, can anyone tell me another thing that you might have to look at? I've mentioned it this morning, just see if anyone's listening. You're not far off. European Union regulations won't in themselves alter the tax dynamic between even two member states. The directives may insist that there are certain anti-avoidance rules that are brought into domestic law. I think, did I mention the multilateral instrument? The MLI? Yeah, okay. As we'll see, the MLI is sort of blinking annoying, because you think you've done all your homework, you've looked at how the rules work in Australia, you've looked at how the rules work in Germany, you've looked at the double tax treaty between Australia and Germany, and then guess what? There's a whole load of standard provisions that are also, they pretend are in the Germany-Australia double tax treaty because of the multilateral instrument. So you have to look at those provisions as well. We'll talk about that when we're doing double tax treaties tomorrow. But yeah, as we can see, the withholding tax rate from the Netherlands to Saudi is 5% under the double tax treaty. Sorry, it's 5%. rather than the domestic rate of 15%. So that's a classic example. I mean, often withholding taxes are restricted to quite low rates under most double tax treaties, normally single figure rates. It varies, but that's what that is about. And there you go, the MLI is mentioned there. The MLI was intended, because double tax treaties operate in all sorts of different ways, it's intended to insert some standard clauses that are just assumed to be in double tax treaties, even if they're not actually there. Okay, I'll just mention a couple of cases, because these have been quite useful in determining what is a permanent establishment and what isn't. And the first one is quite a famous case. Anyone read this? This is to do with Dell. You all know Dell, computer manufacturer, yeah? And if I just tell you what the facts were in this case, I mean, it's up there on the up there on the board, rather, but just running through briefly the facts in this. Dell's commercial structure for Europe and the Middle East and Asia, so EMEA, so standard terminology, and in particular Spain, it had a sort of complex structure of different companies, and it led to what was described in court as a blurred and fragmented model for carrying out the business activities of the multinational company in Spain. So there's a big multi-company kind of structure. Importantly, the production facilities were in Ireland, and that was where Dell was claiming that all its corporate tax profit, all its corporate taxable profit should be. And that purchased products from Dell Europe, which was another Irish company, and sold them to the local Dell subsidiaries under commissionaire arrangements. So it sold them to the Spanish entity, not to what was supposed to be a Spanish taxable entity, but to what they believed to be commissionaire arrangements, to people who were going to go and sell them on their behalf, but not conclude contracts on behalf of Dell Ireland. Yeah. Interestingly, though, Dell Ireland had no personnel of its own. It subcontracted all of its people functions to other connected entities. And Dell computers were sold in Spain by Dell Spain, the commissionaire, under a commissionaire agreement with Dell, the principal. And Dell Spain sold them under its own name. By the way, it wasn't significant in court that Dell Ireland and Dell Spain shared the name Dell. It was accepted they were separate entities, and whether or not Dell Spain was a commissionaire or whether it was carrying on, whether it was actually a dependent agent or some other taxable entity by virtue of being a PE, wasn't actually affected by that. And Dell Ireland's function was the sale of computers and the management and control of the distribution in the different markets through local distributors, functionally characterised and remunerated as commissionaires, but which actually performed substantive activities from a business perspective. This is what the court found, beyond a mere commissionaire function. And the big one really was this. The first question that the court looked at was, did the Irish company have a fixed place of business in Spain? And this brings out a point I made earlier on, because it didn't own any premises in Spain. But the conclusion was that Dell Ireland did have access to premises in Spain, the premises that were owned by Dell Spain. And that was enough to give it a fixed place from which it can carry on business. That's the first thing that the court said. Yeah, and the court really looked at the fact that the Irish company didn't have any employees of its own. So by natural extension, the Irish company was carrying on functions that had to be kind of visceral. They had to be part of the overall business of Dell Ireland. So that was an important thing. And the final one was that what did Dell Spain do? And ultimately what Dell Spain did was all it did was basically work with the principal and sell the goods of Dell Ireland. And that was the fatal thing. That was the thing that stopped it being a proper commissionaire arrangement, because it was really a dependent agent. So even though technically it wasn't signing contracts in the name of Dell Ireland, you ended up with contracts that were for Dell Ireland. And even if they weren't contracts for Dell Ireland, they were going to be contracts for Dell Ireland, because the spec of the kit that had to be delivered to the ultimate customer had to be one that was produced by Dell Ireland. So ultimately, that's what it came down to. And the exclusivity of the activities undertaken by what they claimed to be a commissionaire in Spain, the exclusivity of that pretty much defeated any case that there was that it was anything other than a fully taxable entity and a PE. Yeah, this is indicative of the fact that you probably have to look a little bit beyond, again, just the point about permanent establishment, because this involved a case where an Australian company with an Indian subsidiary, a company that was carrying on business in Australia, and royalties were being paid from Australia to India for the use of IP. They thought they'd come up with a clever way of actually getting away with there being any tax on this at all, because they thought they could characterize what was really a royalty payment as actually a business profit. And so they'd come up with something that worked absolutely fine from the point of view of a permanent establishment. It didn't actually result in there being a permanent establishment. And that's what they went to court on, is there a permanent establishment? Except this is indicative of the fact that, be careful what you wish for, because the court agreed that there wasn't a permanent establishment. The court agreed that there was only a commissionaire arrangement. But actually, when you look at Article 7 of the Double Tax Treaty and the definitions in that, you'd actually find that you did have something that was really a royalty payment. And so the thinking was that it could fall down a gap between the two, and the court really concluded that there was no gap between the two. So if you're ever looking at something that you think is really very, very clever and just isn't caught as any type of income that's covered by any double tax treaty, then think twice, because that's one that kind of suggests the opposite. This case went the other way. This went in favour of the taxpayer, and this is actually useful in demonstrating what's meant by the business carried on in a particular entity. Do you remember we said that you've got to have a fixed place of business to have a permanent establishment in a particular jurisdiction? And this involved a UK publisher that publishes an Arabic language newspaper. And it does have a Paris bureau, so it's got a Paris bureau, and what that Paris bureau does is it gathers lots of information about the market in France for this particular publication. And the French authorities thought that meant that there was a permanent establishment and you could attribute profit to that. The conclusion of the court was that that isn't right, because all it's actually doing is gathering information. It's doing market research, in a sense, and that isn't the same as carrying on the business in that jurisdiction. Yeah? So that's actually one that went the right way in that respect. And the final one, I've got to say, I'm a bit surprised this ever made it as far as court, because this one is to do with this is to do with Formula One. And it was whether the Formula One track counted as a fixed place under which you were carrying on your business. And all of those different things were looked at. It comes back to this point about, this is my example of, I said, plant and machinery not being in a building. Well, this is kind of the example, because the question is whether a racing track, not actual building, but the track itself, which doesn't look like a building, it's something very, very odd, because most businesses don't actually operate a racing track, whether that could somehow be a fixed place. Well, it's pretty fixed, isn't it? So I've got to say, I'm not quite sure what the argument there would have been. And it is it's got to be a place where a business is carried on. The business is that of staging races. So I've got to say, I'm quite surprised in that respect that this ever saw the light of day. But I think the point was that it wasn't a fixed place of business in the normal sense. It was a little bit unusual. But I would have thought that, a sporting venue, a football stadium or a racing track or something like that is pretty obviously something that is fixed. It's pretty obviously a place. And if you're making money from staging sporting events, then I would have thought it was pretty obvious that you've got something that satisfies all the criteria for you to have a fixed place of business, I would have thought. So that didn't rely on any of the changes that we've seen in the model tax treaties. That was just something that the Supreme Court decided was definitely something Supreme Court of India decided that was definitely within the rules relating to PEs. Everyone happy so far, yeah? Okay, I'm just going to talk now about the point that I talked about before, and I read the definition from the double tax treaty. This is to do with attribution of profits to a PE, because like I say, is a PE necessarily a bad thing? Well, you've got to have a PE to start off with, but then for that to have any effect at all, you've got to be able to identify some profits of that permanent establishment. Can you remember what I said we needed to do when you look at a permanent establishment in order to identify if it's got any profits? Well, what we do is we look at those profits by doing now what the definitions require is we do a functional analysis. So we look at what is actually going on in that permanent establishment. What is that enterprise really doing? What people does it have working there? What functions does it have working there? What assets does it have working there? What's the risk associated with those assets? How's it all financed? What financial assets does it have there? And as we mentioned to our PE specialist, to our TP specialist friend here, this will all be quite familiar concepts. And the idea is that you've got to look at it in that context and applying that kind of analysis, determine if it was standing on its own 2 feet and if it were interacting and dealing with its host country, with the parent or with the country carrying on the main business. What profit would it really make? And there's been a lot of academic debate, and you might be able to enlighten us on whether this makes any sense at all. There's been a lot of academic debate about whether how you go about this, because there's 2 ways in theory you could go about this. You could go about it just using, if you like, the layperson's view of whether or not this produces a profit. But actually, the definition that now relies on in Article 7 throws you onto the transfer pricing principles anyway, or whether you apply transfer pricing principles and you use a transfer pricing methodology to identify the profitability of that entity. And I've seen different commentaries, some of which say this makes not a blind bit of difference, some where people get very, very excited, as only academics can, about a subject like this. And I'm not really sure what the answer is. Sir, do you have a view on that at all?
Not particularly, we just read the first rate of the OECD transfer pricing.
So you're
Read the first rate of the OECD transfer pricing also.
Right, okay, so you're straight onto a transfer pricing analysis anyway, because that's what you know. So why would you do anything else? Like I say, there was a lot of debate in these kind of circles, but I'm not sure any of it means anything. So it's very academic in its nature. Ultimately, I mean, in terms of the level at which I'm advising people on this kind of thing, you're going to be using some common sense principles. I mean, you're going to be ultimately doing a transfer pricing exercise if that's required. But, the common sense will tell you whether or not this thing standing on its own 2 feet is producing any money. And then the exact extent of that may ultimately come down to a TP analysis and using the methodologies that are required under that. But some very eminent people have concluded that it actually doesn't matter that much. Okay, and if we're looking at just a computation of the profitability of the PE, then what we're looking at is we're looking at the expenses incurred, including general and administrative expenses of that entity. So it's not just the things directly incurred in acquiring stock or paying for staff. There may be some functions that are undertaken, whether in that state or elsewhere, that are general business expenses, and they would still be deductible when we're looking at calculating the profits. And it's Article 7 that lays down that definition that I gave earlier on. Ultimately, what you've got to do is you've got to look at what the entity would be like if it was standing on its own 2 feet, if it was carrying on whatever it's doing as an independent business, and it was dealing with its home country on a completely arm's length basis. And like I say, the extension of the wording requires you to do that functional analysis to work out what is actually going on here. The extent to which that affects that calculation that you're coming out with, probably nothing at all. Okay. Yeah, and once you've worked out how you're going to be attributing profit to a PE, you're going to stick with that, unless you can find a decent reason for something that's changed to mean that you can do it in a different way afterwards. And that does mean that if you're in a negotiation with any taxing authority about what the correct method is for identifying the profit attributable to that PE, then it's a good idea to get that right, or get that to a point where it's acceptable to you and your client at the outset, because you are going to be stuck with that and nothing's going to move you from that. And this is Article 9, is this what I was talking about before. This is really where we're looking at applying transfer pricing principles to this. So I'm not going to go into this in any detail, because this is looking at associated enterprises and the methodologies that we apply for looking at determining the cost at which we transact between those entities. And this is the point that I was making earlier. That there was a whole report on this as well. There was a section of a report anyway that looks at whether you take what I'm referring to as sort of the common sense analysis in Article 7, which is just look at the business at its own and work out how it would do, or whether you look at the Article 9 analysis and do that first. And does one approach result in a different outcome to the other? I'm not convinced it does. But the simple thing is, you're quite right. The guidance is that what you do is use Article 9, which is the transfer pricing principles first, and then before you apply Article 7. If that means that you apply transfer pricing principles and come up with an answer that you don't like, and then can have a go under Article 7, possibly, but you probably won't come up with an answer that you like any more. So I think that's all a bit academic, really. Ultimately, what you're looking at is, you've got to imagine that this is a business on its own, standing on its own 2 feet, and the transactions that it's undertaken with its parent are on an arm's length basis. There are kind of risks and opportunities presented by the PE rules, but the point that I'd make is one that I was making at the start, that it's mainly to do with knowing what the situation is. Because, I've come across situations where we actually want there to be a taxable entity in another country. We want them to be taxed there. There can be all sorts of reasons for that, by the way. I've come across situations where we wanted somebody to be taxed in the jurisdiction where it was doing business because we wanted transparency. We wanted it to have a proper tax record there and a corporate tax record. And, that was actually adding something. But you've got to know, if you're going down that route, if you're accepting that there is a PE here and you're accepting that there's something that is taxable, you've got to understand what that means in terms of profit attributable to that entity. And if you work that out, remember you do have the alternative of sidestepping the application of PE by actually having a taxable entity in that jurisdiction. So you can set up a company in that jurisdiction. You don't have to worry about PE rules in those circumstances. What you're doing then is you're then just looking at the interaction of those 2 countries and the dynamic between them in terms of withholding taxes under the domestic law and as restricted by anything in the double tax treaties. And, and the example I've given there is for China. China charges a 10% withholding tax and a 5% business tax. So actually, you'd be better if you're operating in China, operating through something that is a PE. So you'd be better operating through a commissionaire arrangement where you hold your hands up and say, well, that is actually taxable as a PE. That's where that would be taxed. That then wouldn't be taxed in the home nation. So that would actually produce a better result. So it's like, I think the big thing is that you've just got to understand the ramifications of these rules and understand when they apply and when they don't apply, and just have some certainty on it. That's really what it's all about. I'm not sure why there's so much about people avoiding PE status, because it's normally not that as big a factor compared to the other factors. And actually, you can probably use something that that produces overall produces a better result. I guess what it comes down to is that when people start transacting with countries, and they're already being taxed in their home country, and it never occurred. They think, for crying out loud, the last thing we want is to have some tax liability in this other jurisdiction as well. We're happy enough with being taxed where we are, and so if you like, the default thought is, well, you keep out of that jurisdiction. So in that sense, I can understand why people sort of think avoiding PE status is a great thing to do. But it really does all depend on the circumstances. Okay, and if you are setting up an offshore function and your view is that you don't want there to be a permanent establishment, then these are the kind of things that you need to be thinking about. If you're sending people over there or you're employing people over there, there's a real risk that you are going to be creating a PE. Is that a bad thing? Not necessarily, but you've got to factor that in. So there's a real risk if people are going over there that you are creating a PE, because generally you're going to have somewhere for them to work over there, and if they work together at a fixed location, then that's starting to look a bit like a PE. And if you have a location that is purely yours, that is exclusively yours to use for your company, that's also more likely to be a PE. If, by comparison, you rent some office space or you have some hot desks available, which is some kind of hub or something like that, that's much less likely to create a PE. It doesn't matter if the company, back in the home country, if the company owns those premises or rents those premises. Owning them is not a requirement for that to contribute towards the definition of a PE. They've just got to be there and got to be available. And a big one that we touched on was, is the business of the company carried on there? And remember that if you've got activities that they don't repeat, they're not habitual, and they're short term, so it's a one-off little foray into a particular jurisdiction, maybe to gather some information, as we saw in the French, in the Paris case. If that's the nature of what you're doing, then probably you're not creating a PE. Once you've got something with any kind of permanence, with any kind of repetition, anything that's kind of visceral to the business, anything that anybody from the outside would see as really being an integral part of the business operation, if that's going on in the target destination, then that's much more likely to give rise to a PE. And a point made in the bottom bullet is that even seconding employees overseas can create a PE. It might not occur to you that it creates a PE, but if you think about it, all the features are there, aren't they? If you second somebody to work, if I second some staff to work for PwC in Berlin, then they're making some space available for those staff, so we've got a place that's available. It's fixed pretty clearly. They're going over there and they're doing the kind of duties that they would undertake in the UK. Well, that's kind of carrying on the business, isn't it? So you've got all the elements that appear to mean that you would have a permanent establishment. So just be aware that setting up an offshore function can give rise to a PE, even in circumstances where that may not be, it may not be obvious that that should be the intention of the law, or that anybody would really think that was likely. Come back to the same old question: is that a bad thing? Is that a good thing? All depends, and it depends on other factors as well. I think what it's all about, when we're looking at PEs, what it's mainly about is really factoring it into your overall decision tree, making sure you understand where a PE can arise and where it might not arise. The biggest thing with PEs is really the problems that arise when people inadvertently create a permanent establishment that they just didn't think was going to happen, rather than when they plan out investment in a particular jurisdiction, they plan out undertaking a business in a particular jurisdiction. That's different. When you've sort of planned it out, you might be perfectly happy to have a taxable entity in that jurisdiction. Really, the risks from PE arise more from stepping on tripping over an obstacle that's there. And, managing it's important, because if you get a challenge by a tax authority in a country where you're doing business and you weren't expecting that, that's going to cost some money. It's extremely uncomfortable. You're probably not going to be familiar with the manner in which you defend that. So getting a challenge in a foreign jurisdiction can be quite uncomfortable. And obviously there's interest and penalties if you end up being challenged on that, whereas if you paid it all up front, you would have been fine. And if we're planning it out and we're managing it properly, then actually you'll probably find you can identify a better way of doing it anyway. So unless you identify clearly that you're not going to create a PE, you probably think, well, there's actually a better way. We'll create a taxable presence and we'll take advantage of the double tax treaties. If you have planned it out as well, if you were to get a challenge, let's say you plan it all out, you work it all out, you think about what constitutes a PE, what doesn't constitute a PE, you come to the reasonable conclusion that what you've got is a commissionaire arrangement, or what you've got is just a third-party arrangement with a sales force who work for 6 other companies, and they just happen to be doing your bidding as well, 1 day a week. If that's what you come to the conclusion of, and you document that, then should you ever have a challenge in that particular jurisdiction, that will probably give you some defense against the worst that that local tax authority could bring against you. So that's quite big. And, you know, if you get it wrong, I'll come back to the top one in a bit. If you get it wrong, then yeah, when you've not budgeted for liabilities, they always hurt a lot more, don't they? When you get a bill you weren't expecting. That's the kind of thing you can get with PE. You're not going to be the best mate of the local tax authorities. We're going to be a bit worried about what other things you might be doing. And we see that a lot, where once you've got on the wrong side of the tax authorities, then they're pretty keen to keep an eye on what you're doing. And so you can expect some increased scrutiny. Your accounts might be all wrong. And depending on what the local rules say and depending on what the requirements are, you may have to issue a whole load of new accounts. And depending on the size of the company and depending on the nature of your investors and other people to whom you're answerable, this could be quite scary. And of course, as I say, you've got penalties and interest that are to be levied. And just go back to the first one. To what extent is reputational damage an issue with anybody, do you think? Do clients speak to you about, do clients worry about this? Is this something on clients' minds? Anyone have a conversation with clients about undertaking planning of this type and reputational concerns? Anybody? Anybody got a thought? Common sense question for everybody. Just to get a bit of conversation going. The client's bothered if they get in, what happens if you have a challenge that you have to defend? What's that going to be? I mentioned 4 cases there. How do I know about those?
It's in the news.
It's in the news. If it goes to pretty much any level of court, it is public. Pretty much every judicial system publicises the results in one form or another. That's part of most countries' justice system. So it's going to be publicised, right? So it doesn't even need to make the newspapers. You can Google any, you can just search for any tax case and you will find different companies and you can find the details of any tax decision. And sometimes, has anyone been to court? Can you raise your hand if you've been to court to defend a client or anything? One hand at the back, yeah. You'll know that, you know, when things do get before a tribunal or before a court, you can get some quite damning statements being made about different people and the evidence that they give. And judges, yeah, they don't pull any punches. They tell you it how it is. That's what their job is. And so this can be quite damaging and can be quite stressful, to be honest. Anybody when you're involved in any dispute. So although it may seem fine, and I often talk to people about, oh, we'll definitely win that and we've got a really strong case. In reality, do we really want to end up there? And the answer is no. And this is one case where I think you're in control of that. I think if you're undertaking, it's the place where you're probably most likely to inadvertently run into problems that would end up where you'd end up having to defend it in court, and at the same time the one where it's easiest controlled if you actually think about it beforehand. So, you know, but if once things end up in court, even if you've got a very good case, even if you win, there can be a lot of sort of spin-off damage. The reason I mention reputational risk is this, for me, is over the past 5 years, this has been a game changer. And tax authorities have been aware of this. They know that people don't want to be associated with tax avoidance. They don't, even if what they're doing is completely legal, even if what they're doing is completely fair. The press tend to misinterpret these things quite badly. I had a client who was involved with a firm called Mossack Fonseca. Does the name Mossack Fonseca mean anything to anybody? Yeah, would you like to remind us, sir, what Mossack Fonseca were famous for? The Panama Papers, thank you very much indeed. The Panama Papers were basically a law firm, perfectly reputable and good law firm based in Panama had their systems hacked by a disgruntled employee, and the disgruntled employee sent papers around to lots and lots of clients. And I had a client who had a newspaper contact him about his own affairs. Fortunately for him, the newspaper was the Nottingham Evening Post. Have you all heard of the Nottingham Evening Post? Possibly not, because that's a regional newspaper, and quite a small regional newspaper. And the journalist in the Nottingham Evening Post hadn't got a clue what he was reading, so actually he asked all the wrong questions, which is just as well, because alongside the completely innocuous things that the journalist asked about, my client had some quite aggressive things going on as well. But because the journalist didn't understand it, he asked the wrong questions. But in the wrong, and this particular client wouldn't be bothered anyway, but I know lots of clients who are dealing with governments and have lots of clients who are reliant on being popular, reliant on having a good reputation, and actually being on the wrong end of this stuff is really viewed quite seriously nowadays. And that's been, to my mind, one of the most successful strategies of different governments in tackling tax avoidance. Because only going back 10, 15 years, people would think this was quite clever. And it was just what rich people and what successful businesses did. That isn't the attitude now, far from it. And people really do not want to be on the end of bad publicity in this kind of arena, in my experience. So that's why I wanted to dwell on that point. It's an obvious point, it's not a technical point. It's common sense, isn't it? But it's shifted dramatically in terms of emphasis. And that's been in my mind, the single most successful measure that any jurisdiction, that any taxing authority or court or anything else has imposed to tackle tax avoidance. It's made it unacceptable in the public opinion. And actually, in the UK, we've noticed a kind of blurring of the distinction between tax avoidance and tax evasion. So the Chancellor of the Exchequer, whoever that is today, it was Philip Hammond yesterday, it'll be somebody else today. The Chancellor of the Exchequer, when he stands up now, he talks about, normally in the same sentence, tackling tax avoidance and evasion. That's very clever. Now, the poles apart, they're completely different. But in the public view, they're similar, and they're bad. And so accidentally creating something for a client, that means they're in court and up in the public eye for being on the wrong end of trying to mitigate tax. However fair and reasonable that was, is a really bad thing to do. So managing a risk like this is really sensible. Yeah. I think that'll do. So thank you for your attention there, ladies and gentlemen. Does anyone have any questions at this stage? And if anyone's got a question, we have a microphone, a roving microphone, so you'll be recorded for all time. And yeah, your words may be taken down in news and evidence, so just be aware of that. Anyone got any questions at all? That's probably scared everybody off. Yeah.
So you mentioned if you second your employees, it will create a PE, or it could create a PE.
Cool. Yeah.
What about if you're seconding your employee to your client's site, for example?
It's actually the same. It's the same. It's pretty much the same quantum of risk, I would say. I mean, that said, I'm struggling to think of any case where I've seen that taken in the UK. And I've come across situations where employees are seconded from overseas. I can't think of any way in which being your client changes the overall analysis, other than things we look at more in terms of substance, for example. That's a lot easier because it's obvious. Your commercial rationale for sending employees out to your client, it just makes sense for everybody. And you've not done it so that you can do something in a way that means you don't have a tax liability. You've just done it to meet a commercial end. Yeah. So in that respect, it's helpful. Although that isn't actually built into the PE rules. Substance does come into most things, and it sort of spills into all this analysis to some extent, as does the GAR. But technically it doesn't. So I think that's the only difference it makes. I think that on a substance type analysis, you'd be on much stronger ground than if you If you sat down and thought, right, how the hell do we push our business into Spain without getting a taxable presence there? I know. We'll find some guys where we can subcontract. We can actually put them over as on secondment. You get the difference. And if you're doing it with a client, there's almost certainly there won't even be a suspicion of that. Okay. Technically, no difference. Visually and in terms of practical outcome, probably a big difference.